他是最有名的美联储主席，任期跨越6届美国总统。他被认为是美国国家经济政策的权威和决定性人物。在他人生的巅峰时刻，他被称为全球的经济沙皇、美元总统。在他的盛大的谢幕前后，对他的批评声却不绝于耳。人们开始追问格氏主政期间的种种失策，赠予他一连串新的头衔：机会主义者、谄媚者、两面派。他如何看待自己在任美联储期间美国经济出现的2轮泡沫
？Bubbles are intrinsically difficult to prevent.
The issue is we can't avoid those, and history tells us you cannot avoid them. The question is, what do we do when they collapse?
他又如何看待2008年美国房地产市场的崩溃
We in the United States have had a dramatic collapse in our real estate markets, basically because we didn't have adequate buffers.
他对中国的金融政策会有怎样的建议
What do you think the policymakers, especially your friend Governor Zhou, should do?
Well, you have a very narrow range in which you set the exchange rate on a daily basis with intervention. First thing you could do is to widen the range.
网易财经特邀诺奖得主萨金特、耶鲁大学教授陈志武、北京大学教授姚洋对话格林斯潘，精彩内容即将呈现。
How you think about the balance between private market measures to control risk and government or central bank measures to control risk on the part of private agents. How do you think about striking the balance, and does one crowd out the other, or?
Well, as you know, Professor, this is a very debatable issue within the United States. I think that despite the crisis that the U.S. banking system, U.S. financial system, had following the Lehman Brothers collapse, it's very apparent that in the decades preceding that, we had the status of not having a very high savings rate, but we used our savings in a more efficient manner. And the reason that that occurred is that our system is very sensitive to the question of how savings are moved from, say, various different savers, households, business, etc., how those savings are moved to finance high-tech, high-productivity, cutting-edge technologies, because standards of living can rise only if you get a rise in output per hour or productivity. And a rise in output per hour can only occur since facilities, physical facilities, are major forces, if you are using the scarce savings to invest in the high-tech type of equipment and allowing the obsolescent equipment to basically phase out, and in fact depreciation charges in those types of equipment are put into high tech. Now, what this says to me is that a private system left to creative destruction, which is a very difficult political issue to handle, does in fact, by its very nature, will create the most rapid growth in standards of living. But there are other questions involved in the use of savings and many other questions which are involved in various social issues which have to be put into perspective. But from my experience, the evidence is that the most efficient systems are necessarily private systems, and in many respects, because there only is a limited amount of savings generated in a society, if government basically preempts a significant part of it, that type of equipment or that type of savings cannot go to finance other equipment. And that gets us down to the issue as to whether or not government investment, especially in infrastructure, for example, can compete strongly with the private sector. And I suspect in certain instances they can and do, but it's I don't know of a general proposition which covers it all.
Related to what you just mentioned as high-tech finance, especially after the financial crisis, many people, economists and non-economists in the U.S. And in particular in China, have been criticizing the emergence of complicated finance and too many and too much financial innovations. So even a lot of officials in China just keep reminding people that finance should be secondary, should serve the real economy. Try not to switch the real economy around to make it a secondary to the financial economy. So what is your opinion on financial innovations versus the real economy?
I would say that financial innovation, some of it is good, some of it is bad. Innovation is not necessarily always good. It may be poor innovation. It may be a misuse of resources. But you can't forecast that in advance. And therefore, this is the reason why I've concluded that given the issue of the inevitability of bubbles and the like, that the solution to the problem of finance is more capital. I'm coming around to the opinion that with a combination of contingent convertible capital and equity, I would like something in the area of something like 30% of capital to assets. Now, if you have that sort of capital, then you could tolerate a lot of innovative mistakes, and believe me, we had a great number of them leading up to the 2008 crisis. But there is no need for the rest of the system to run into trouble because there are mistakes, provided that it is the shareholders of the individual institutions who suffer, not the debtors or taxpayers. And I think that we should be able to be in a position where we can say that, yes, you can use this type of innovation, but you have to put up enough capital because of the probability in one form or another that it will fail, and because governments now stand behind financial intermediaries to an extent that has never existed before, we have to find a way in which the system will work, and the only way I think it can work is to make certain that the type of capital that we saw, for example, in the United States in the 19th century actually is the appropriate levels to deal with. Now, I'm not saying we should have the numbers they are, but just remember that when you had fully private markets in the United States, say before our Civil War, capital requirements for state-chartered banks on average were more than 50% of assets. And so it is not insane to think in terms of very significant amounts of capital, but rather than to regulate a system to fine-tune things which we cannot forecast and really cannot regulate well, the simplest thing is, as a general way, let people do what they want to do, but charge them for it, and charge them enough in a manner that taxpayers and other parts of the society are not afflicted. Remember, it is only the issue of default on debt which creates serial problems of contagion, which is the root of all major collapses, toxic collapses of bubbles.
Another topic that you've contributed to is Social Security reform. So I think in 1980, the early 80s, under President Reagan, you chaired a commission that proposed successfully some reforms to the way our pay-as-you-go Social Security system was funded. We face similar, maybe equally difficult problems today, and how do you see us making progress? Is it going to, would such a commission work today? Could a president appoint that, or how do we go forward on that in the United States?
Well, I think we know pretty much what the nature of the Social Security system is, and I think the most fascinating thing is to read the annual reports of the actuaries of the Social Security system. Despite the fact that their statements are being signed off by cabinet ministers, they are nonetheless saying that the system is underfunded. That is, the original Social Security system in the United States began with, in 1935, in which a system was set up which tried to replicate private industry defined benefit pension funds. But a fixed defined benefit fund often requires very significant amount of funding. And it's really an actuary who can tell you how much must be paid in on a fixed base, on a continuing basis, to create the assets that will pay off the liabilities of the recipients of benefits after they retire. Unfortunately, even though we started off in the 1930s with good intentions, they deteriorated to the point that we ran into significant underfunding of Social Security to the point where we ran into the necessity of having a 1983 Social Security Commission to effectively set the system straight. But even then, the political system required a 75-year window for the amount of funding. And it's what seems rather surprising is that that turns out not to be actually actuarially sound. And the reason is that, and we saw it in the 1983 commission, we funded the whole system for the next 75 years. But the problem basically is that when the 76th year showed up, the fund was significantly in deficit again because we eliminate a period when there is excess payments into the system and add to it a period of very sharp very large liabilities. So the problem is we do not fund these things accurately or properly, and there is no way to have a defined benefit program. I would say today most of the pressure is moving towards so-called defined contribution type of benefits in the United States. I'm not quite sure how that would be applicable in other countries, especially in China, but that system, of course, is working because it cannot default.
I was struck by the degree of caution you have raised about the danger of bubbles. But I'm quite curious because in your term, there were two bubbles that have happened. One .com bubble, the other one real estate market bubbles. So my question is, thinking back today, do you think that you didn't do enough to prevent those two bubbles, or do you think that bubbles are intrinsically difficult to prevent?
I regret to say it is the latter. I think that we cannot change human nature. And what history tells us is that euphoria builds up and then it gets confronted with fear and you get the expansion of a bubble and then its collapse. The issue is we can't avoid those, and history tells us you cannot avoid them. The question is, what do we do when they collapse? Well, it is very clear that the innumerable bubbles which have expanded and collapsed and caused no significant after effect were those types of bubbles which essentially had no debt associated with them. And as a consequence, yes, there were very substantial declines in capital values. Capital gains or losses were very large. They did marginally impact on economic activity, but remarkably little. And so that sort of situation, I think we can't do anything about and probably shouldn't, because implicit in these euphoric bubbles is a very major change in gains in innovation and moving forward in the area of technology, and that's probably good rather than bad. What we have to, however, avoid is the issue of getting too much debt, too much leverage into the markets, because that, as we saw in 2008, was catastrophic. And I could argue and would argue that that was a once in a 100-year type of phenomenon, which we're not going to see for a significant period of time. But nonetheless, we can avoid even that with the appropriate balancing of how one approaches this, essentially with adequate capital and the innovative new debt instruments, contingent collateral debt, which, as you know, triggers when a certain amount of liquidation occurs of the equity of a firm.
At this moment, personally, I think there is a lot of euphoria in China, as well as outside China, about the Chinese economy, let alone the Chinese real estate market. There's almost too much euphoria. So what would be your advice?
Well, I think that when you're dealing with the real estate market, debt is inevitable in the sense that that's the way the structures are required to work. But I think it's quite important to make sure that the amount of down payments on homes and other real estate is sufficiently large that it could capture and neutralize a significant decline in price. We in the United States have had a dramatic collapse in our real estate markets, basically because we didn't have adequate buffers. But the actual housing bubbles in the United States are no different from where they were in Canada or Australia, and indeed virtually all of the other major industrial countries had bubbles of approximately the same size. They, namely, for example, Canada, didn't have the problems that we did with the crisis, nor did Australia, nor did a number of other countries. And the reason, essentially, is that they had enough of a buffer where we in the United States did not, and our lack of buffer caused serial contagion. That has not occurred in a number of the other countries. And I think China should seek out the model which most captures the spirit of the Chinese basic attitude towards risk in a manner which does not create serial contagion.
Thank you, Dr. Greenspan. That's a very diplomatic response. Will take us back to the 2008 financial crisis again. That is, some commentators have attributed the 2008 financial crisis to market failure. Others have attributed it to the lack of regulatory oversight. With the benefit of hindsight, going back to the 90s and early 2000s, as a chairman of the Federal Reserve, how would you have done things differently, knowing what we know now? I know this is something many people have asked you to comment on. So,
looking back at the period, I asked precisely that question. In fact, I wrote a book recently, which is the one I mentioned before, in which it tries to raise the question: how is it conceivable that all the best forecasters in the country failed to pick the specific point in which the crisis would be triggered by the Lehman event? Now, this tells you that there's something fundamentally wrong about what we're doing, and I basically conclude that had we back then set up what I'm suggesting now, namely a system in which much higher equity to asset ratios are required of banks, not only for their capital but for their collateral, and the introduction of a type of bond that is contingent collateral, convertible rather, that sort of situation almost wholly eliminates the problem that caused the collapse, and which is in fact caused by the contagious defaults. If you don't have debt, it cannot default. Collapses in equity will cause some deterioration in expenditures and hence in a little bit in the GDP, but it will not break the system. What happened, which is different from any other time in history in the United States, and I suspect in the world, is not only did we get a collapse in prices, but we got a breaking down of the market structure itself. For the first time in over 100 years, for example, overnight markets literally shut down. The last time markets shut down in the United States was not in the 1930s, but 1907. For one day, the call money market in the United States did not function. But all through the period of the Great Depression, the markets remained open, and we never had the type of situation which we ran into where overnight credit disappeared, meaning you couldn't get bids. Trade credit, for example, virtually disappeared, and that caused a dramatic collapse in international trade almost immediately. And it's that sort of problem that we have to confront and assuage or eliminate. I know of no simple way of setting up a whole abstract technical regulatory structure, because to be effective, you have to be able to see into the future. And so I would argue that we should not have any regulation which requires regulators to forecast. We cannot do that. People want us to do it. Nobody can look over the horizon. We can make probabilistic estimates and the like, but we should never be in a position where regulation requires the forecast judgment of a regulator. That's the reason why I find that simple issues of capital, which doesn't require a forecast, collateral, again, which doesn't require a forecast, should be the way that we should focus on the issue and not try to do too much, because our current regulatory system is becoming unduly complex in the United States, and I don't think it serves our financial purposes or the economy very well, frankly.
That is, after your term, we have had Chairman Bernanke. So now we have a yearly favorite, Janet Yellen. What do you think of the incoming Fed Chairwoman, Yellen?
She's an extraordinarily competent, in fact, an excellent economist. As you may know, she served as a governor when I was chairman, and I found I would often go to her office to sit down and get her advice on certain things and certain problems which I thought she knew more about than I. And I will be very surprised if she doesn't do an exceptional job, as I assume she will be confirmed in the United States Senate. But it will be a very tough one, because it's one thing to preside over a opening up of credit, which is very politically satisfactory in the United States and elsewhere. But she will be involved in the significant issue of how does one pull in the expansion of central bank balance sheets to remove any remote possibility of huge disruptions that they could create if they are not delimited in size reasonably soon.
Recently, the topic of opening up the capital account of China, especially allowing the Chinese currency, renminbi, to be more freely convertible, and also allow capital to move in and move out more freely. What do you think the policymakers, especially your friend Governor Zhou, should do in terms of the timing and the magnitude of each step in moving the capital account towards full liberalization, in order to minimize the amount of disturbances to the real economy in China and also beyond?
Well, you have a very narrow range in which you set the exchange rate on a daily basis with intervention. First thing you could do is to widen the range gradually, and now obviously that would improve the situation. Unless and until you are freely floating, it's going to be very difficult for the yuan RMB to be a major global international unit of account. I mean, it is true that the RMB is increasing its status as a means of payment, but it cannot have a very major role in the issue of capital movements unless and until the exchange rate moves freely in the marketplace. And I think that certainly China is moving in that direction, but there's no question that the buildup of your $3 trillion liquid asset structure, that is reserve balances, is essentially the result of endeavoring to hold the exchange rate at a level which kept low-cost goods competitive in Chinese trade with the rest of the world. So it's a very interesting and difficult trade-off. If you obviously allow the exchange rate to move up to where it probably would be in equilibrium, you would have economic effects domestically, and I think that's the reason why it's not being done. But that's where the basic policy trade-off is. There are very great advantages to becoming an international currency, but there are costs in moving in that direction.